I want to use this class to remind you of how we handle disposals in consolidation. Now, there are the disposals, there are dimensions of it you must know. Last diet, for example, there was a disposal, but the disposal was inside your ratios. The disposal was inside your ratios, and the way you handle the disposal affects your P&L figures. So I realized that my students in Tema brought it to my attention that, the only thing that distorted their past was that there was a disposal in the ratios. And so I want to use this opportunity to help you deal with how we do disposals in any consolidation question before we look at our main question that we want to look at today. All right. So as far as disposal is concerned, there are two types of disposals. Number one, we have disposal. You know, consolidation is all about you having an interest, all right, in an entity, and to the extent that you control the entity. So we call it subsidiary. Now, we have a situation whereby you can dispose part of your shares and lose interest, your controlling interest. So we have disposal with losing interest. So when you dispose and you lose interest, there is a way we do it. Now, to dispose and lose interest is, for example, I used to have 70%. Then I disposed, let's say, 30% of my 70%, or out of my, let me use the phrase, out of my 70%, which means I'll be left with what percentage? Yes, I'll be left. I need your engagement, and I need you to pay attention so that you understand. So how many percentage will I be left with?
40.
40. Good. Which means that in this form of disposal, I have lost my controlling interest. That is something you must see. All right. Then there is another form of disposal. That one, when you dispose, you still maintain. When you dispose, you still maintain interest. In fact, even with this one, let's say I had 80% in interest and I disposed the whole 80%. It means that I have lost my interest. That is what it means. Please, I would kindly ask you to mute if you are not talking to the class. It's very important. So if I have 80% and I dispose the whole 80%, it means that I will be left with 0%, which means this one too, I have lost control. Now, another scenario is that, let's say 80% again. Then I dispose of 60%, all right, out of the 80%. So I disposed 60%. I will be left with, or let me even make it more than 60% because of what I want to do. I dispose 70%. I will be left with just 10%. This one too, I have lost interest. Take note of that. Now, you see in the first scenario, I lost interest, but I still have an interest in the entity, which is called associate. This one, I lost interest. I have a zero interest, which means that I have nothing. You have nothing in there. So this one, you have nothing. Then the last one, I dispose everything, but I still have an interest in there. That interest that I have in there is called an investment, because we say that from 20% to 50%, an associate. Please kindly check your muting thing for me, please. It's very important to me. Okay. So if you do have 20 to 50%, it is called an associate, or if it is 50-50, you can even say a joint venture or anything. That one, the form of accounting we use there is called equity accounting, which is IAS 28. That is that. IAS 28. Now, this one, the form of accounting applicable is IFRS 9, investment. So you know financial assets. That is what you have in there. All right. Please, at this point, I want to leave the podium to ask if you have any question here to the point that I've done. Is there any question you want to ask? All right. So if there is no question, then let's move on. What then is the accounting treatment that we do? What do we do in this particular scenario? And in this particular scenario, it's very interesting because it means you are going to reverse some 3 workings that you have done. Cynthia, do you have a question?
Yes, sir.
All right, I'm listening.
What if you have exactly 50%? Like 50%?
It's still an associate. It doesn't mean you have control. Please, control is when you have more than 50%. If we share everything 50-50, nobody controls anybody.
Okay, sir.
All right. So that is that. So sometimes they make it a joint venture stuff, like we are half joint venture issue. But that is it. The point is that we use equity accounting. That is the point. All right. Now, what do you do if there is a disposal and the person has lost interest? So remember, if he has an associate interest, you apply the IAS 28 onwards from that day of the disposal going. All right, you apply it. Now, what do you do? What is the accounting treatment? Now, this is the thing you need to do. You need to find the gain or loss on disposal. All right. How do you do the gain or loss on disposal? You need to find the proceeds, the fair value of the proceeds that he is collecting. Please, I wish you write. Don't let the class be like, oh, you have joined the class and earpieces in your ears and you are just listening. No, please. We need to take serious caution to our attitude towards the joining of the class. So wherever you are, sit down, take pen, take book, get it once and for all. There's no time. All right. And if you have a question, ask the question. Don't let it slide. It's very important. So fair value of the proceeds, when you sold the percentage that you sold, how much are you collecting? You will need that. Then you add the fair value of interest, the interest that you have not sold, fair value of the interest you retain. So if, let's say, you had 70 and you sold 30, how much are you collecting for the 30 that you sold? That is what is here. Then the remaining 40 that is left, what is its fair value? You will have to add it. Then when you are done, then you are coming to less the interest disposed. So you less your interest disposed. Interest disposed. Now, what is your interest disposed? You are giving out certain things. So you have to less fair value. You are taking out fair value of net asset at disposal. You see, this is your workings too. You are disposing it off. You are doing it. So find the fair value of net asset at disposal. At disposal, not at acquisition. At disposal. Good news is that most of the time, this part of the this line is usually given in the exam. So when you do this part, you are going to total it somewhere. Then this one to you bring it. Then, so this is your workings 2. It is gone. Then next, your workings 3. You need goodwill at disposal. So that is your workings 2. So this one, sometimes if you don't take care, you have to do the workings. You have to do it inside. Like, fair value of the net assets. At acquisition, then you add the profits they've had till the time they dispose it. But good news is that most of the time the exam it is given. Goodwill at disposal is your goodwill at acquisition. So you have to do it the way you do it, your normal goodwill at acquisition, the same thing. But you have to check if there was an impairment before they dispose. So if there was an impairment, then you deduct the impairment. The remaining is probably what they will dispose. So that is that. Check if the disposal date is after an impairment or before an impairment. Check it. So you will need that, and you will cancel off your goodwill. Then the last thing is your workings 4. That one too must go. So you will less that workings 4 from these two. That is NCI at disposal. Where are you going to get the NCI at disposal? It is the same your NCI that you do, your normal NCI that you do when you are doing consolidation. That is what you are disposing it of. So that one, you are taking it out of these ones. Then don't forget, it is a less here. So after that, you are lessing everything. And here, you get your gain or loss on disposal. Where would this thing go? If you are doing consol P&L, this figure will go to your SPL as gain or loss on disposal. It will go to your P&L. If the question that you are solving is consol balance sheet, then this figure, where do you think it will go? Where do you think it will go?
Group retained earnings.
Group retained earnings. So it will go to your workings 5. Get it clear. This is all you need to do. This is all you need to do. So please take note of that. Are we clear? All right. I hope you understand, please.
Yes, sir.
All right. You see, when you have something like this, all you need to do is to find questions these things are in, then you practice it. See, there is no way at your level you will do a consol P&L without a disposal. It's not possible. So please take it serious. Then there is another form of disposal. That disposal, you don't lose interest. You don't. You don't. Now, how does that one manifest? So let's look at console disposal without losing interest. Disposal without losing interest. You see, all these things are in the book that you bought from me. This thing I've done, it is in the book. Now, so we have disposal, and this disposal, you don't lose interest. Disposal without losing interest. Please, disposal without losing interest has nothing to do with P&L. Take note of that. Disposal without losing interest, it has nothing to do with P&L. So therefore, if there is a disposal without losing interest, it is a transaction between equity shareholders. It has nothing to do with P&L. Nothing of it goes into your P&L. So what do? Assuming I had 80%, then I decided to dispose of 5%. I still have interest, and the interest that I have is still a controlling interest. So that is that. So in that case, if I have disposed 5% of what I have, and now it means that I will have a 75, right? It means my interest there will be a 75. What you see in here is that my NCI that used to be 20% is now what? 25%. I hope you can see clearly that that is what is happening. That is it. All right. So how do you treat this? We say that you do the proceeds from selling the 5%. Now, what is the proceeds from selling the 5%? The proceed that I'm going to get for selling the 5% will come. But you compare that thing to the increase in NCI. Increase in NCI. So my NCI will increase. So in these things, you have to be very, very careful, because if you are doing a balance sheet for something like this, it means when you are doing your NCI, there will be two things there. NCI at the point when it is 20%, NCI at the point when it is, what do we call it? 25%. They will all manifest in your workings for. Take note of that. So you do that, then the answer that you get is going to your OCE, other component equity. So this thing has nothing to do with balance sheet, P&L, sorry. So if you are solving a P&L, consult P&L question, and they do this thing, and they don't say anything about it, like if it has been treated in the P&L, it means you need to reverse it. But if it hasn't been treated in the P&L, and they are expecting you to treat it, pretend as if that note was not even in the question. Yeah, pretend as if it was not even in the question. So what will happen is that you take the proceeds. At the time that they were disposing that thing, all right, I have sold 5, so 5% is what you sold. Now, how do you do this increase in the NCI? The increase in the NCI, I always teach it like you can do, or you can just do the NCI, what he sold out. He sold 5%. So the 5% that he sold out, multiply by the carrying amount of his investment, the investment that he has in there, carrying amount of his investment that he has in there. So when you do that, you can get it straightforward. All right. So basically, that is that. The carrying amount of his investment. So normally, we say that you can do when this thing happens, you can do it in the individual books. You can also do it in the consolidated financial statement. In the individual books, it's very, very simple. How you go about it in the individual books is that you are going to do, what do we call it? You are going to do the proceeds that the person collects. So let me do this thing for you. I'll come back to this because the NCI is actually 25%, but I'll come back to it. Now, this is what will happen. So you are going to do in the individual books, you are going to do the proceeds receipt. That is this. Then you less the how much he has in there, the carrying amount, which is the cost. The carrying amount. How much did he buy that thing? What he is disposing, and how much is he selling it? So basically that is that. But because he's not losing interest, he bought 80 and he is not selling out everything. He's selling 5%. So the 5% that he is selling, the cost of the 5% that he's selling will be the 5% of the 80% he had before. So 5% of the 80% investment he had before. So what is the fair value of the 80% he has? Is his investment there today? What is the value? So he is selling 5% of the investment he has in there today. So he is selling 5% of that. So you do 5% out of 80%. So this is how we do it. So I'll prefer you do it like this. 5% out of the 80% multiply by the investment that he has in there. But if he is selling everything, it is everything. It's not some percentage. It is everything. So that one will be just the cost, the carrying amount of everything. But if he is not selling everything, then he is selling some 5% out of the 80% he has of the investment he is getting there. He had there. So you deduct it. And this one is also a profit. So ladies and gentlemen, this is it. All right, this is it. So please take note of that. This one is in the individual books, not the consolidated books. But as far as the consolidated books is concerned, what you are going to do is to do, so for example, in the book, hold on, let me bring you what is in the book so that you see. So the increase in the NCI will be multiplied by the CA, the carrying amount of the net asset, and the goodwill. That is how you find this percentage. Now, how we treat this thing in the group is that you are getting proceeds, so you debit cash. You are collecting money, you debit cash. NCI is always added to your equity side of your balance sheet. And so if your NCI is going to, this one shows an increase. So increase in your NCI means that you are going to credit your NCI. So that is that. And the difference is either a debit or a credit to your OCE, depending on your net figure. So please take note of this picture because we are going to zoom into solving questions that involves disposal. You have to bring that thing to bear, this analysis to bear, all right? Okay, please, at this point, if you have a question, you can ask because we are going to go to the question that I put on your platform. I've not, only one person tried it for me to see, and that is Henry. He brought his solution to me in the office or at campus. But I felt like let's go through it together because I am of the view that in this your exams, you may have the consult P&L. So with this understanding, let's go to the question. Okay. So that is anytime there is a disposal, that is what you are supposed to remember and do. All right. So let's take a look at the question. It says that the draft P&L and the OCI of for the year ended 30th September 2018 has been outlined for you as follows. So you have for TAC, you have for PTS, and you also have for UIPD. Okay. Now, breaking this down, you have your revenue, cost of sales, you have everything. I mean, everything is made available for you. So take a look at them quickly. Then we will come to the footnotes where we will have to draw our group structure with it and everything. This is console P&L. So you don't have to go through and do your normal traditional workings 1, workings 2, workings 3, workings 4, workings 5. No, this is when it is console P&L, even your workings 2, sometimes the figures are given to you. There is no need to do your workings 2. So from your traditional workings 1, which is your group structure, you move straight to do your goodwill. It's just that sometimes when you are doing the goodwill and it is proportionate, it means that you need to find the fair value of net asset acquisition if the question doesn't give it to you. But if the question does give it to you, then it means you are fine. Yes, Rich, your hand is up.
So your voice has gone down.
All right. I think you may have to bear with me small on that because I dropped my earpiece somewhere. Yeah, I think I left it at home. I'm fine. So
Okay.
anytime it goes down, just alert me. Okay.
Okay.
But is it better?
Yes, it's okay.
All right. So we are going to go in and read the question, the additional information. So we have, it says that on October 2016, now I've told you that anytime you are solving a console question, usually this date that you see is also the reporting date. But just confirm it, and this is it. All right. So you know your reporting date. Now, we have on October 1st, 2016, TAC acquired 60% of the equity of PTS. So right there, you have your first. So we have TAC, who is acquiring PTS, and he is acquiring 60% of him. The date of that acquisition is October 1, 2016. Okay, a public limited company in Ghana. The purchase consideration is made up of 40 million, and it's made up of cash of 40 million, and fair value of the identifiable net asset acquired was 55 at that date. So you see, like I said, the things you need in your workings too have started showing up. The fair value of the non-controlling interest in PTS was 22.5 million on October 1st, 2016. That's the NCI acquisition. It said that TAC wishes to use full goodwill method for all acquisitions. All. And it says that the share capital and the retained earnings were 12.5, and the stated capital was 32.5 million respectively. And OCE, other component equity, was 3 million at the date of acquisition. And it hints you that the excess of the fair value of the net assets, identifiable net asset at acquisition, is due to a non-depreciable land. Okay. And it says that goodwill has been tested for impairment annually as at 30th September 2017. Remember, where do we calculate goodwill? Immediately they buy the entity. That day is when you calculate goodwill. That's why your goodwill is called goodwill at acquisition. And so you saw that they bought the company on October 2016. So by September 2017, it's 1 year. And they said that goodwill had been reduced in value by 20%. That means impairment is 20%. That's all. However, the next year is at 30th September 2018. The impairment of goodwill had reversed, and the goodwill was valued at 1 million above the original value. So interesting. This upward change in value has already been included in the draft financial statement of TAC. Below of TAC, this one should be above, of TAC above, prior to the preparation of the group statement. Now, here, write this down. If you have watched your impairment video, please, goodwill impairment can never ever be reversed. Please write it down today. Goodwill on impairment, impairment on goodwill can never ever be reversed. But you see, in this question, they said that it has been reversed and they have made the change in the financial statement. It should not be. So it means that that change they have made in the financial statement, you should reverse that change, because goodwill or impairment of goodwill can never ever be reversed. I hope you have noted it down. All right. If you face any question, they are trying to tell you that there's a reversal of the impairment of the goodwill, please, it can never ever be reversed. All right. But they told you that the goodwill, the impairment has been reversed, and they have already recorded them, even prior to the preparation of the group account. So take note of that. All right. Then note 2, TAC disposed 8%, the same 8% in PTS. So you see a disposal. Now the 8%, does it make it lose interest, or it still makes him retain interest?
Retain interest.
It makes him retain control. Sorry, like control. It makes him retain control, right? So if he disposed 8%, then it means that it is now going to be 52%. Then what day did this happen? It happened on September 30th, 2018. Isn't that the reporting date? Meaning that they did this thing on the very last day of the reporting date. The very last day of the reporting date. Take note of that. Dates are important. And he said that he disposed that 8% for cash for 9 million and had accounted for the gain or loss in other income. Okay. So we will talk about that, because I just spoke about that before coming here. That when there is, what do we call it? The disposal without losing control, it is a transaction between only equity shareholders. And so it has nothing to do with the P&L. Do you remember?
Yes, please.
Yes, sir.
So they are saying they have accounted for it in the other income. So whatever that other income is, it means that thing must be removed. All right. Take note of that. See, that's why I expect you to write certain principles, key principles down, because it comes and bites you. All right. So it says that the current amount of the net asset of PTS at 30th September, meaning the day they did the disposal, was 60 before any adjustment on consolidation. All right, that's fine. That's fine. TAC account for the investment in subsidiaries using IFRS 9 financial instrument, and has made an election to show gain or loss in the other comprehensive income. How do you treat subsidiaries as IFRS 9? Subsidiaries are treated using what type of accounting? Who remembers?
Equity accounting.
That's not true.
Subsidiary. Associate.
I'm talking subsidiary. You are also talking associate. So which is which?
Accounting.
Yes, please.
Say IFRS.
I can't hear you, Maureen. Come again. Acquisition accounting. Yeah, that is it. IFRS 3. Acquisition accounting. Please, these are basics of the consolidation. If you get them wrong, your head is cut off. So take key importance to these things. All right. Now, and it so says that the carrying value of the investment in PTS was 45 million as at 30th September 2017 and 47.5 at 30th September 2018 before the disposal of the equity interest. So you remember the format that I gave you. So whatever interest that he had there is 45%. So he was selling is 47.5. That day he did the disposal is 28. So he's selling 8% out of that 60%, which gives her or him the 47.5. Take note of that. Take note of that. All right. So we come to note 3. It says that TAC acquires 60% of UIPD. So there's an introduction of another acquisition. So we have to draw another one, UIPD. And he acquired 60% of that on the date is 30th September 2016. The purchase consideration is 35. UIPD's identifiable net assets were 43 and NCI is 14. On 1st April, TAC disposed 40% equity interest in UIPD. So you see, he has 60%. Now he has disposed 40%. So it means you'll be left with what? 20%.
20%.
Good. Have you seen this type of disposal? So you see, in this question, all the two types of disposals are there. Disposal without losing interest. Disposal, now he has lost interest. So now this one is on April 2018. If our reporting date is 30th September 2018, what does this period mean? So he did the disposal, where is the date? On 10th April. That makes it from this date to September is 6 months, right?
Yeah, 6 months.
Yes, 6
That
months.
means that he was a subsidiary for only 6 months in the year. So serve for 6 months, associate for or investment.
No,
So
it
this
was-
one is 20%. 6
I'm telling
months.
you, it was 1 year, 6 months. Oh,
I know, but you know you are preparing finance. This is P&L. You do P&L
okay.
for 1 year, no more than 1 year. Take note
Okay.
of that.
Okay.
Because it's actually 1 year, 6 months. But if you are preparing consult P&L, if it is balance sheet, yes, I agree, 1 year, 6 months. But P&L is done for only 12 months. Yeah. So in the 12 months you are preparing the financial statement, it is 6 months subsidiary, 6 months associate. Very interesting. But if you were doing a consult balance sheet, yeah, it's 1 year, 6 months. It's true.
Is it investment or associate?
Please come again.
Is it investment or associate?
It's associate, please. It's not less than 20%.
20 to 15.
All right. So that is that. So that is what you have in there. It's a very interesting question. It means you will have a lot to do. Yeah. So it says that as at the time they were doing all these things, the net asset was 45, NCI was 17. So you remember control with losing interest. It looks as if it's making the job easy for you to give you the figures at the date of disposal. To make the job easy for you. The remaining equity interest was fair value at 20. So you remember fair value of consideration, fair value of interest retained, less fair value of net asset at disposal. You are seeing the figures. Fair value of goodwill at disposal. I think the goodwill, you have to calculate it. Then NCI at disposal, you have seen all the figures. After the disposal, TAC exerts significant influence. Any increase in net assets since the acquisition has been reported in the P&L, and the carrying amount of the investment in UIPD had not changed since the acquisition. Goodwill has been tested for impairment and found that no impairment was required. No entries has been made in the financial statement for this transaction other than the cash received, which means that the gain or loss on disposal have not been recorded. That's what they are just trying to tell you. Then we have note 4, which talks about TAC sold inventory to PTS 6 million at fair value. This is intra-group and it is P&L. You just have to. But it said TAC made a loss on transactions of 1 million, and PTS still hold 4 million of the inventory at the year end. You see, every time you do consult, you do PAP, and it is a profit. This time round, it is a loss. So all of a sudden, you are like, this thing is new. But please, if it is a loss, it is assumed to be impaired and it is realized. It is not unrealized. Profit is unrealized. That's why we call it provision for unrealized profit. But loss is realized. And therefore, there's no need for any adjustment on that. Take note of that. All right. If this is something new to you, this is where you write it down. Okay. Then note 5. TAC on 1st October 2016. TAC purchased an item of PPE for 6 million. And this is being depreciated using straight line method over 10 years with no residual value. At September 2017, the asset was revalued to 6.5. But at September, the value of the asset had fallen to 3.5. TAC uses the revaluation model for its non-current asset. The effect of the revaluation at 30th September 2018 has not been taken into account in the total comprehensive income, but depreciation for the year had been charged. This one, it is not like he purchased it from any of the subsidiaries, so you cannot say it's intra-group, blah, blah, blah. This is just a straight PPE stuff. So you can deal with this one. This one is not a problem. Then, the last note. On October 2016, TAC made an award of 4,000 share options to each of its 11 directors. The conditions attached to the award was that the directors will remain in employment by TAC for 3 years. The fair value of each option at the grant date is 100. Fair value of each option at September is 110. At 30th September 2017, it was estimated that 3 of the directors will leave before the end of the 3 years. Due to economic downturn, the estimate of directors who were going to leave was revised to 1 director at 30th September 2018. The expense for the year as regards the share option had not been included in the P&L for the current year, and no director had left by 30th September 2018. So this one too is IFRS 2. Easy peasy, you can deal with that. But it looks as if revision of all these things, somebody will look at it and say, hey, this one is another wahala. Just calm down. You will have it. So, ladies and gentlemen, this is it. So we have an issue at hand to deal with. So normally you do your workings too, and your workings too, what you are looking for is the fair value of net assets at acquisition reporting post-acquisition. That is what you normally do. But it looks as if this one, some figures were given. It's just that they said that there are some differences that are due to fair value adjustment, that are due to non-depreciable land. If it is a balance sheet, that is fine. But since it is not a balance sheet, fair value adjustment, a land that will not be depreciated, will have no impact on your P&L, unless it was something that you are going to depreciate again. Because fair value adjustment on land is a balance sheet stuff. It's a balance sheet stuff. So you can still decide to do your workings too, but sometimes to looking at the question, you have to have mastery and ignore certain things. Yeah, it's very important. Because if you need your, for example, let's say we want to do workings too, the traditional workings too. What you need is fair value of net assets of SAP You know, as at the time we are doing this, there is a sub here, there is a sub here. The two of them are sub at the acquisition day. Careful. We do these things at acquisition. So fair value of net asset of first one will be PTS. Then on the second, you have to do same for UIPD, because we do this thing immediately there is an acquisition. So if you have at acquisition, at reporting, post acquisition, you have to repeat this one at acquisition, reporting, post acquisition. You realize that the answers were given you. Of course, the post acquisition P&L is there because this one they bought it, it's a full year coming down. It is on the last day they did the disposal, but that disposal is not a full disposal. So you realize that this one, when they acquired this one, PTS, all the 11,000 is a full year. So you can put it there. But we are interested in this one for now. Of course, we will need this part to do our, what do we call it? NCI sharing to the P&L thing. But you don't need to really use the format for it. Good news for you is that they gave you this part, and here they gave you stated capital, retained earnings, OCE, and they said that there's a fair value adjustment, which is the difference. Because the fair value adjustment has no depreciation, we are doing console P&L. It is useless. It is useless. What was the fair value at the date of net identifiable net asset? For this one,
55.
So let's put some 3 zeros in there. It's 55. So you have it straight up. This one too, I think it was given. But if you want to fill the bracket, you can fill the bracket, find this figure, but it won't give you anything in your P&L because it has no bearing in your P&L. Okay, because they said that when they did this was 12,500, and they said this is 32,500, and they also said there is an OCE of 3,000. So the difference is the fair value adjustment, but it doesn't really have impact in your console P&L.
7,000.
It's what?
7,000.
7,000, but we won't use it for anything. So there's no point. There's no point. So if you be filling this, you realize that you are filling, but you are wasting time. The reporting date, they had additional profit here. So you have to add it up and get this side, but it's really not necessary. You don't need to stress yourself on that. When you are doing console P&L, the only figure you need is this side. This side, you can deduce it from the P&L, right? You don't need to really stress on that. Unless there is a fair value adjustment depreciation on the date of acquisition and all those things. And there is impairment all right. This one you don't really need. Okay, what about the UIPD? When they bought it, purchase consideration is this, fair value of identifiable net asset, 43, right? So that is all you need. When it's console P&L, you don't really stress on that. But your goodwill is very important. So let's see, let's do the goodwill. Because you know the goodwill, we will need this figure, right? So goodwill for PTS, goodwill for UIPD. Purchase consideration, yes. What is the purchase
40.
consideration? Where is it? 40. What about this guy?
The
35.
35.
35. What else do you need?
fair value
Yeah,
of NCI,
NCI at acquisition. How much is that?
22.5 for PTS.
22.5.
Yes.
Hey, Chairman.
22,500.
22. Then
Uh,
what about the other? So when they bought this thing,
14.
14.
14. So what do you do after that?
You find the fair value of
Fair value of
net asset.
Fair
net
value
asset
of
allocation.
subsidies.
And all those figures were given. So here is 55.
55,000.
Here is 43. So what is our goodwill at acquisition?
7,500 for PTS.
7,500.
7,500. This one.
$6,000.
6,000. All right. Then we talk of impairment. The impairment, they gave us a whole nice story about the impairment. They said that the impairment was 20% as at 2017, but it was reversed. It doesn't mean we shouldn't do the impairment. And I told you that the reversal on goodwill impairment is not acceptable. It's never. There can't be a reversal on goodwill. So 20% of this is what?
1,500.
1,500. So which means the carrying amount of the impairment is 6,000. This one had no impairment. So also 6,000. But remember, in the question, they said that the reversal had been done. I told you that you cannot reverse the impairment. But they said that the reversal has been done, there's a reversal, and even the goodwill, this one, has increased by 1 million. So it tells you that as for the revaluation of the goodwill, you must admit or you must indulge it. But the reversal is the problem. So
But
if the goodwill had increased by 1 million, then it means that at this point, it must go like 8,500. So you can say that the impairment was reversed plus another 1,000 or 1 million. So which means that in all, what you see in there is like a 2,500 reversal. That is what they did. Kind of 2,500 reversal. So if the goodwill is 6,000 here, then it means that the reversal that they did to add extra 1,000 is 2,500 to add extra 1 million to this. So the reversal the reversal that was done is 2,500 to bring this figure to a +1, because that's what they say here. However, in 2008, the impairment had been reversed and goodwill was valued at 1 million above the original value. The original value is this. This is not the original value. This is the original value of goodwill. And 1 million above the original value means that it's supposed to be this. So if goodwill is at this point, then it means that the reversal that happened was 2,500. I hope you get it clear. Which means that the 2,500 has to be, you see, if it is impairment, you deduct. If they reverse the impairment with 2,500, which means they added it back, they added 2,500 so as to increase even the impairment by another 1 million. And so what you are going to do is to go and deal with, subtract back what they added back. I hope you get it. They reverse the goodwill, so you need to go and subtract back the reversal, because the reversal they did was to add. So you will go back and subtract back, which means that you need to add this 2,000 to your expenses. And normally, goodwill is dealt with administrative expenses. So you can even add it to your administrative expenses if you want. All right. So that is that. Any question on that? Yes, Andy Rich.
Sir, what I did was when I got the 7,500 and deducted 1.5, I got the goodwill at reporting to be 6,000. Because I knew that you can't reverse goodwill, so I ignored that statement. Then took it like goodwill. Back. Okay. So I took it like goodwill has been revalued. So I saw it to be increase in goodwill. So I added the 1 million to the 6,000 and I got 7,000.
Oh, okay. Of course, if we were to do balance sheet, fine. But we are not doing balance sheet. So our interest is on the P&L lines.
Okay. Okay.
Yeah. If we were doing balance sheet, your goodwill should be like the figure that you are talking about, 7.
Okay.
Because so therefore when you revert, the problem is that they did the upward value into the draft financial statement. That is the problem. So clearly it should have been like goodwill is like 7,000. Then you reverse back the 1,005 they did. That's all. But it says that the upward change in the value has already been included in the draft financial statement. The draft financial statement you see there is a P&L draft financial statement. Do you understand?
Yes.
Yeah. But under normal circumstance, what you are saying is the normal thing. So here should have been 7,000. Then we will reverse back this 1,005. That is it. So if this is 8,500, then you reverse back the 1,005. Then it means you have 7,000. But they did the upward also in the financial statement you see there, which is the P&L. That is it.
Yeah.
If you were to be balance sheet, then fine. Your argument is correct. Very, very correct. And I like that. Good thinking. Unfortunately, this is Consult P&L, and they have done all the upward change inside the P&L that you see. So the only reversal that should have been happening is the 1,005, but they've done the upward change too, also there, which shouldn't be there. That is the problem.
Okay.
All right. Yes. Any other question? Because we are done with the goodwill. We are going to tackle the disposals that happen, because you know your NC, your fair value of net assets. We don't do workings for when it is Consult good P&L. There's nothing like do NCI working. There's nothing like that, and we don't also do workings 5 in Consult P&L. All right. So now the disposal issues. Let's deal with them. First of all, there is a disposal without losing control. Without losing control. Whereby the guy had 60, he disposed 8, and he now had 52. Then there is a disposal with loss of control. Because he bought 60, and he disposed 40 that landed him with 20. So we have the two scenarios. You have the two scenarios. And what did they do? When they dispose, this is it. When they dispose the 8%, they said that for cash 9 million and had accounted for the gain or loss in the what do we call it? The P&L. Now that one, I made a statement about that. Who remembers? Who remembers? He's not losing control. So yes, who remembers the statement I made?
It is just an equity issue in the
Equity shareholders transactions.
So therefore,
It has
Mhm.
nothing to do with
It has
P&L.
nothing to do with P&L.
so
Yeah,
since
no.
they have recorded or accounted for it in the P&L, we need to remove it. That's the thing. We need to remove it. So we have to remove that. Now, how do we work that? Of course, the proceeds he collected for selling the 8% of the 9 million. So since we are putting 3 zeros at the top, we can write it there. Now, what did he dispose? What did he dispose? Because we are told that certain amount of the investment. And what is his investment? Do you remember what I did for you? That you
Yeah.
add the goodwill, you also add the
Yes.
NCI. You remember?
Yes.
But they've done it for you. Fortunately, they've done it for you. They are telling you that the carrying amount of that is 47 point. This is the date he did the disposal. So forget this one. Forget this one. This is the date he did the disposal. So which means that if his the investment was this is 80%. How much was it? He owns 60%. That is
8%.
60%. No, his investment there was 60%, and he sold
Oh,
Yeah.
8%. So if his 8% gives him this value, his 60% gives him this value. He is selling
8%.
off 8% out of that 60%.
Okay.
So that is it. So if more or less dividing comes in, if 80% is giving you this, how much is 8% of that? So that thing we do if more or less divide. So how will it
Okay.
be?
Okay.
6,000.
Is giving
3.
47.5. What will so 60%? So what will the 8% be?
So 6,093.
It's what?
6,093.
How did you do the 6,090?
8 over 60 times the 47,500
80. So it's what? 8 over 60.
times 45,700.
47.5,
Just
not
3.
45.
47,500.
So how much is that?
6,333.
6,000. Please, if you are not contributing to the class, please.
Zoom use.
Interesting. You see, and you say you are in class, you are not in class. Please give me the figure and the rate.
6,333.
6,333.
There is some 0.33333.
So let's round up, okay? Let's use the roundings.
Okay.
So should we use this? What will we get?
$2,667.
So that is 2,667. Okay. So this must be reversed. So take note of that. When we get to the P&L, please kindly remind us on that. Then let's come to this one. Do you remember the approach with which we do this one? Do you remember?
Yes.
Then let's go. We start with what?
Proceeds.
Proceeds. So fair value of proceeds from disposal. How much are they having? Let's go down.
25.
25.
25. Everything we are doing is in 3 zeros. Then what do you do next?
Fair value of
Fair
interest.
value of the retained interest.
All right. How much is that?
20.
That one too was given 20.
Yes.
So it means that in total we have 45.
45.
Yeah.
Then what do we do?
Less
and
interest in the
Less
NCI
interest to dispose then.
and subsidiary dispose.
Interest in sub dispose. We start with which one?
Fair value of net asset at disposal.
The value of net asset at disposal. How much is that one? They gave it to us.
45.
45. Then goodwill at disposal.
Disposal.
This guy, what was his goodwill at this goodwill at acquisition? Because it is the same thing we are going to dispose, unless there is impairment.
It's 6,000.
6,000. So that goodwill must go because you don't have it anymore. You've lost control. 6,000. Then you less out of these things NCI at
disposal.
disposal. So what is the NCI at disposal? It's also the NCI at acquisition.
17.
Then if they had shared some profit, NCI share of profit, then if the NCI too has suffered goodwill, just the same as you do in your traditional workings for, the final value you will get is what you are disposing. And this one, good news is that it was given, right? NCI is 17. So what do we have?
We have 4.
Please, what is the answer? Guys, help out.
34.
34,000.
34,000.
All right. So what would be the gain or loss on disposal?
11,000.
11,000. Okay. So this 11,000 is a profit. This 11,000 will be in the P&L. Why? Because you have lost control. You have lost control. It will be in the P&L. That one must be in the P&L because you don't control him. You have lost control and it must be in the P&L. All right. So that is that. There is another thing that must happen. Who can tell me? Now, he has an interest. Yes, Andy Rich, your hand is up.
Yeah, I wanted to ask a question that, assuming the NCI disposal were not given and we have to calculate, we would have taken care of the impairments because NCI is a goodwill is full value. NCI is fair valued. Impairment would have affected it, right?
Yes, the way you do your normal traditional workings for.
Okay.
Yeah. I think I gave a question to the squad in Tema. They forgot to share the goodwill. It's in the book. They forgot to share the goodwill. It's a trial question in the book. And it wasn't balancing. In your book, there's a trial question there in these things. You can try it also.
I've seen it.
Yeah, so please, those of you who are trying that question and it is not balancing, it is because you didn't share the impairment for the, I think, do I have the book still here? So I've closed it. And those of you who are doing that trial question and you're probably not getting the solution, it is because you didn't share the impairment to the NCI. So try and share it. You see that you get the answer. I think the final answer is 55,000 or something. I forgot it. All right. Is Ernest in class? I think Ernest and Famous are the one that thing squared them. Jeez. All right.
Give me, my background is very bad.
Oh, okay. Okay. So please, this thing must go to the P&L. But my point is that now the remaining interest is an associate interest. So don't forget there is an associate interest. And anytime you have an associate, what part of the associate must go to the P&L?
Share of associate profits.
Share of associate profits. Share of profit. Now, right now, the associate interest that you have is 20%. That is what you have. And normally, you have to do the retained earnings at reporting minus the retained earnings at acquisition to get the post-acquisition retained earnings, which you are going to share. Good news for you is that you have already the P&L. This is the P&L, and you already have the profit made available to you. It's clear. It has been made available to you. So you need to share that one. That's all. The profit is this with UIPD. Please, it's not this figure. It's this, because if there was a revaluation of course, that is not profit. This is the profit. So it means that this post-acquisition profit, which is 7,500, you bear only a 6 months to the acquisition part. Don't forget the associate part. So you have to do that, and that should also go to your P&L. And how much would that be? Sometimes with this one, you need to find the retained earnings at reporting and minus the retained earnings at acquisition when it became a subsidiary associate.
3750.
So this one is what?
3750.
3750.
Hey, please, I need a third person to confirm.
So multiplying the
3750.
20%.
Now, have you done the 20% with it?
I did it. I got
750.
It's 750.
750.
All right. So please take note of that. So this one, the two things here, this one is going to the SPL. This one too is going to SPL. Take note of that. So we will be doing the SPL. It's just that the SPL, you need to be very, very careful, because this particular one, this particular figures, it was only 6 months subsidiary. So you will do 6/12, 6/12, 6/12 of the figures. Take note of that. All right. Is there any note left untouched? Because, yeah, this one. This one is simple. I've told you that the loss, as for unrealized loss, there's nothing like unrealized loss. The loss is realized. Profit is what you can unrealize it. That's why when you are doing even PPE, we say that if you get a revaluation loss, it goes straight to the P&L. Do you remember? But if it is a revaluation profit, you put it where?
Yeah.
OCI. Do you remember?
Yeah. Yes.
So as for loss, it goes straight to P&L. And so if they have done it, there is no adjustment to be done again. All right. So what you need to do is to deduct the 6,000. So the 6,000 intra-group, so that is note IV. That intra-group, what do? You will less it from, i.e., you will debit your sales and also credit your cost of sales. So basically, that is that. So debit sales, so remove it from sales, we mean like a normal traditional console P&L. Then you credit your cost of sales to, i.e., remove it from your cost of sales. So that is easy. So let's come to the PPE one.
So then the loss of 1 million will go to the profit and loss, right?
But TAC made a loss. So yeah, the loss of 1 million should go to the profit or loss. But this one, they have done everything. So, I mean, there is nothing there for you to do. So you don't do anything, or else if they have not done it, then you have to do it. So if they have done it, it looks as if the question never mentioned that they have put it in, they've actually done that part. So if they've not done it, then you will treat it, okay? But you see, so he said that 6 million fair value, the loss of 1 million, TAC made a loss of 1 million, and ETS still have this inventory in spirit. So if it's not done, you will do it. But if in case it is done, then it means that you will be the one to do it. All right. So that is that. Okay, let's move on.
Hello, sir.
Yes, please.
Sir, please, the intergroup sales, if it's profit statement of financial position, how do you treat it?
Sales is not in balance sheet, so there's nothing to do in balance sheet with the sales.
Okay.
It's just that in the balance sheet, we treat the differences between receivables and payables, not sales.
Okay.
Sales is not an item in the balance sheet.
Okay.
All right. Okay. What are we left with? This part. Yeah, this part, I think you should help me do it because you have done PP. Yes, so you should help me do it. So what do you think we do with that? As for the two standards, since we've gone through the standard, you should be the ones to do it. So, what do you think?
So the cost of PPE is that is as at 1st October 26 million, and depreciation is 10 years. So gets I think 600.
That is accumulated depreciation?
No, that's for a year. So you multiply it by 2, then you get 1.2.
Oh, it says that on October they purchased a PPE.
There was, yes, they did a revaluation B, so I think it will be for a year.
Oh, okay. So yeah, they did a revaluation. So at this date, they did the revaluation. So you have to depreciate it for 1 year.
Yes.
Okay. So the depreciation is how much?
600.
6,000, 10 years. That gives you 600. Eh? So you have what? 54. So that is the CA at September 30th. Eh?
Yes.
So they did a revaluation. Revaluing it to how much?
6,500.
6.5. So it means there is a revaluation surplus. So the revalued figure is
6,500.
6,500. So meaning here's 1 and 1. Okay. That's the revaluation surplus. Okay. Then what else? Revaluation surplus goes where?
OCI.
OCI. Oh, so I should remove my lines. And this, because
Then,
this thing starts at 2017, we are
yes.
preparing account to 2018. So let's continue.
So on 2018, they value the assets and the real it has fallen to 3,500.
There is another revaluation.
Yes.
But when did they do that revaluation?
30th September 2018, the reporting date.
Then it means you have to depreciate first.
Yes. No, sir. They are using the revaluation method. So I think we don't need to do any further depreciation or.
No, revaluation method doesn't mean you don't do depreciation. Fair value method is what you don't do depreciation on. Please get the difference as well.
Okay.
If you use go back to your PPE lessons. If you use revaluation method, you apply subsequent depreciation on the revalued amount. That is, and you guys should remember something about anytime we are doing this. I hope you remember just in case it happens. There is something I hope you remember just in case it happens. So subsequent depreciation, I think as for Maureen, you will remember. This is 6,500. Subsequent depreciation is 9 years. Take note of that. Yes, you've already spent 1 year. They didn't change their useful life. So how much will the depreciation be? And I think Mary too, you should remember that thing.
722.
It was 722.
Yes.
Okay. So at this junction, so what is the difference?
5778. Yeah.
5778. Okay. Guys, what do you remember?
Sir, MK. There was.
Checking the
Somebody like
excess depreciation.
Maureen and Mary, you should know what you should see.
So excess depreciation.
Excess depreciation. It is between the fact that before all these things, depreciation was 600, and now depreciation is this. So you were told that the thing was revalued again after the depreciation.
Yes, it has fallen to 3,500.
3,500. And even you and the rich, you should know that because you are the one that I remember when we were doing that impairment question. So there's a revaluation loss, and people were in a rush to go and offset the revaluation loss with the figure that is in the OCI. And I said, hey, because you have not done something first. You remember?
Yes.
This is it too. That you see how the exams is.
Yeah, I didn't see it, so I forgot to cry.
So what is the difference?
2,278.
It's what 2,000.
278.
2,278. Good. So normally, since the asset has a figure in the revaluation, how do you share this one? How do you do this? The offsettings, how do you do it?
Sir, wait. There is excess depreciation and
the question says they do such transfers.
he said the effects of the revaluation at 30th September 2018 had not been taken into account in total comprehensive income, but depreciation for the year had been charged.
So what do you see?
Depreciation for the year has been charged. Sir, so we'll reduce. Sir, so the excess depreciation will be deducted from the revaluation OCI, the revaluation reserve that went to OCI.
Okay, so how much is the excess depreciation?
1,100.
122. Which means that the balance that will be left in the OCI will be how much?
978.
978. So if you are sharing this thing, you know this one must go and offset with the remaining going to the SPL, right?
The loss, yes.
So how do you do the split? So first of all, 978 will go, then the remaining is going to your SPL. 978 will offset this figure, unless the examiner says you don't do. But so far as it's silent, it means you have to do.
Okay.
Yes.
So can you then add the excess depreciation to the loss and deduct both from the revaluation reserve, the 1,100?
That's exactly the same thing that we are doing. What you
so
are
you
saying
get 1,300.
It's what?
1,300.
1,300.
That is what is going to the SPL.
Yes.
Yeah.
Good. Guys, have you seen it? Have you seen how this thing works? You learned a standard somewhere, they brought it in somewhere.
Hey, I see.
And
this little deductions in our Mama Jumo.
Yeah, but you see, somebody might choose to offset 1,001 with the revaluation of loss. Then the balance that is left will be the one going to the SPL.
So your voice.
Hello, can you hear me?
Yes, it's louder now.
I said somebody might decide to ignore the excess depreciation, but you have to be very careful about it because the excess depreciation is a transfer to retained earnings. All right. And since we are doing consult P&L is also your retained earnings. I always say that anytime you are doing consult P&L, it is the same as your retained earnings. So even with this one,
how do you get a 978?
Oh, is the difference after you? This is it. This one minus 122. This is it. Minus 122. That's what they give us. So check. If it is wrong, please alert me. So what I'm saying is that if you are doing console balance sheet, this figure must go to your retained earnings, 122. But if you are doing console P&L, your retained earnings is also the same as your P&L. All right. So this one going to the retained earnings is also going to the SPL. So at the end of the day, even if you had made a mistake and not do it by just offsetting only 1,001 from the OCI and keeping the balance in this thing, it would have still been correct. That is
the effect would have been the same.
Exactly. So that is it. You are fortunate.
So, but this question looks very there.
Just make sure you understand certain things. I believe that you will have consult P&L, sincerely speaking. But we have to prepare all round, okay? So that is that. The last one, who can help us do it? The
share base.
The share base. Yes, who can help us?
So our 4,000 share options multiplied by so 2016.
When did they do the share options? On 2016.
October 2016.
So but we are preparing financial statements in which year?
2018.
2018. Okay. But you know that because it's 2018, 2016, we have to do for financial year end 2016, which will end in 2017, right?
Yes.
Sir, we can't hear you.
Voice.
Okay, do the IFRS 2. I want somebody to do the IFRS 2. We've done IFRS 2, so I want somebody to do it. Be bold, be bold.
Sir, I'm trying to. Are we solving it or you say?
No, you have to tell me here. Now, what type of instrument is that? Which is it, equity settled or cash settled?
Equity settled.
Equity settled.
So which fair value are you going to be using? Because he gave you
At the ground date. 100.
Okay.
The ground date.
Okay.
So 4,000 share option is 4,000.
We want the number of employees.
Say 7. So at 2017, it was estimated that 3 directors would leave before the end of the 3 years. Due to an economic downturn, the estimate of directors who were going to leave were revised to 1. So in 2017, for the end of 3 years. So say I think
3 years. But we don't need that for anything because we are preparing financial statement for 2018. So they started with 7 directors.
So to me, 3 will leave. So you deduct 3.
So 7 minus 3.
Leaving 4 directors.
Guys, do you agree?
So 4 directors multiplied by 100 Ghana cedis, multiplied by 4,000 shares, divided by 3.
There is 1/2. It will be divided by 1/2.
Why
No.
1/2?
We are doing for 2 years.
The contract is 3 years. We are doing for
the contract 3 years.
We don't need the last.
Oh, okay. So we'll end at 2018. Okay.
So the expense the OCE. Then the
So
number
you
of
get
staff. Okay, you give me the figure.
you get 533. Yes, 533,333 cedis. 0.33333.
But we are keeping 3 zeros up, so it means
Yes, so 533,333.
no. After keeping
No.
3 zeros up,
It's 533. That's all.
yeah.
533,000.
Yes.
What about the second year? The second year.
The second year,
This, it was revised to 1.
1.
So we have 6 directors left.
But they said no director had left by the end of 2018. So I think it will be 1.
That's why. So we have 6 directors.
Yes.
So by 100.
That's all.
By
Yes.
4,000. Multiplied by 2 divided by 3.
What is our OCE figure?
Our OCE figure is uh, 1,600 to cumulative expenditure. Then we have the expense for the year to be 1067.
All right. So this is the P&L figure we needed. You can do the last year, but we don't need it. We are doing P&L. We don't need it.
So assuming we are doing the last year, then it will be 1 plus the 3, right? Since the question was silent on those who left in 2019.
And so you use actuals. This one you use actuals. So the one who actually left will be the issue, not no more estimates.
Yeah.
All right. But we don't need that. We are done.
Hello.
Yes, we are done.
Hello, sir.
If you are doing it in the exam perspective, I don't expect you to do it this approach. I expect you to start drafting P and a long time. Start with it a long time. Because as far as you are concerned, the only issue that bothers is the 6,000. So you don't need any workings for that. You should do that one long time. All right. So let's draft the console P&L. So we have tag group.
Hello, sir.
Yes, please.
Yeah, please, I want to ask you. So, for instance, the 2019, since we don't need that one in our solution, if you don't work it out, will you lose mark for it?
You will not lose any mark. There's no point in doing it. You are wasting time. In fact, it communicates that you are doing the work based on fear and panic.
Under pressure.
Yes. So now that you have something you can do, you want to really do. So consolidated profit or loss. I still don't understand why in the undergrad level we call it profit and loss. And another comprehensive. Please write it in full. In your exams, write it in full for the year ended 30th September 2018. All right. So we pick our revenue is 200,000 plus PTS
57.
Subsidiary 57,500.
500.
Then this one was a 6-month subsidiary.
Yes.
So 6/12 of 35.
35,000.
Minus, do you remember the sales?
Yes.
Yeah, 6,000.
6,000. Yes. So do that. Let's have the figure. Cost of sales is 156,000 plus 32,500
500.
plus 6/12 of 18, also minus the 6,000.
6,000.
Then we get our gross profit. You just repeat what is there. There is other income here. So the other income, the same thing. The other income, what you are going to do is to add we have 10,500 plus 3,500 plus 6/12 of 1,000, right? Then we have something we need to deduct. Do you remember the profit they put in there we need to reverse?
Yes.
Or you can actually keep it like this and come and do reversal of that profit. There was a profit on disposal. Where is it? This one.
2667.
2667. You can decide to write this thing that you have, but then you still have to find a place to reverse that profit. So 2667. You can give it a workings number, but we didn't really number our workings, but you can give it a workings number. All right. Then admit, don't forget admit to, we need to do a reversal be over there. Which was the impairment thing?
This one.
That's the solution.
7,500 plus 4,500 plus 6/12 of 6,000. So the impairment, by reversing the impairment, we are adding it to an expense because they deducted by reversing the 1,005 before. We are now redoing the whole reversal of the 1,005 plus the 1,000 they added, if you remember. So it means our expenses is going to be plus 2,500. Impairment is always included in what do we call it?
Sir, please, so the 2667. I thought it was income on the disposal.
Yeah, it was an income, but they recorded it. They shouldn't record it. Remember, we said it's a transaction between equity people. It shouldn't be in your P&L, but according to the question, they brought it to the P&L, so we are reversing it.
Okay. All right. Thank you.
Yeah, so that is why it is like that. Because they didn't lose control. So we are reversing it. And it was a profit. They added it. We are reversing. Yes, Andy Rich.
Sir, we didn't touch on the share of associate profits.
Oh, we are not done. That is a one-line item. According to equity.
So I was thinking we'll add it before we come to administrative expenses.
No. That thing is an investment, like an investment income. We do it after your operating profit.
Oh, okay.
Yes, it's equity accounting. One-line item. See, this is what happened in your last diet question. And they disposed, they did a disposal. So
please say your voice.
Sir, we can't hear you.
Oh, Charlie, this voice thing, is it better?
Yes.
I said that this is what happened in your exams, your ratio question last diet. They disposed the subsidiary. So what you were meant to do was to do the workings on disposal of a subsidiary and let it have an effect on your P&L so that your ratio figures that you will pick to recalculate will change. Do you understand? Hold on. I'm bringing up your ratio question. last died. That is July.
Dispose of Abanga.
So sometimes you need to do transfer of knowledge of what you've been learning. And that is why what ICA really requires from you, not a static mindset, but rather a professional mindset. Go to your ratios. And I'm sure last year you did disposals. So it's like people are probably shocked. Why is there disposal in ratios? Look at this. Look at this. You are meant to calculate these things. But you see, the truth is that there is a disposer. Where is the information about the disposer? In fact, they did it for you. They said that on July, he disposed 80%. Which means that this one is a disposer to lose interest. A disposer to lose interest, which means the gain or loss on that disposal should reflect in your P&L. So, and the total cash price is 150,000. Initial goodwill recognized has been impaired 3 years. The sale resulted in a loss of 30. So he has done the loss for you. He has done a loss for you. So there is a loss on disposal. And it says that which had been included within the administrative expense. So that is what they did. But it is a one-line item. It shouldn't be in your administrative expense. So, Rich,
yes, sir.
Like the way you are saying we should do it before, it should be after operating expenses. So what they did here is that they have put the thing in administrative expense here, which shouldn't be. It should be after profit here. It should be after you have gotten your operating profit, then you bring it. Because they have put it inside here, it will affect your calculation of ROCE, profit before interest and tax, the figure that you will pick.
Oh,
so you have
I understand now why I got the 39.
So you have to do that correction and take it out. You have to take that money out of your figure.
Administrative expenses.
Exactly. And come and slot it somewhere after operating expense so that your ROCE calculation will be right.
Oh.
That's all.
So you see, just like the way that's one thing I like about you, just like you are telling us. Sometimes we will not know. We know the ratio is just normal ratio. We will never know that there can be
when I did intervention on March 2024. Unfortunately, you remember something happened in this. Those of you who, if you were with me in March 2024, I gave you a ratio question. I gave a ratio question called octopus. In octopus, there were adjustments to be made so that you have to change. If anybody joined my intervention, that was what I was expecting, the type of ratio question I was expecting. Unfortunately, it rather came in July, where you have to adjust the figures with some additional information so that you will have your figures right to do the analysis. As for online, this died, I think at the point there was a swap, like there was a change. But I also didn't add those type of questions anymore because this time around I was expecting a different type of ratio analysis. So, but you see, what at the end of the day, what you need to understand is that standards are everywhere. That's all. They are everywhere. In fact, your ethics is standard. Everything is standard. Sustainability is standard. Everything. So you should embrace the standard. Other than that, it will be a problem. It will be a problem. that if you really ground yourself in the standard, you'll be okay. You'll be okay. All right. So that is it. So let's finish drafting our P&L. So the positioning of the thing is very important. And IAS 28 says that we should present it as a one-line item, just as you would do for IFRS 5. Do you know, and those of you who have my book, there is part of this thing you do in console called subsidiary bought for the sole purpose of resale. Is there?
Yeah.
How to account for that?
Fair. Yeah, when I was solving your question, I realized it's some confined family coach to be the my young movie I am from. Seriously.
Anyway,
since day.
So the impairment that happened, we need to also, and that is it. This is the impairment. So that is that. Then you pick the next line item, which is other expenses. So you pick them just like that. Then you remember the reversal that we need to do here. You see this one. This one hasn't come. Which form of expense does this one go? This one too is even an administrative expense. It's a staff expense. Staff expense is also an administration expense. So it means that I should even add this one to my admin. You see, people don't take serious IAS 1. Nobody is interested in IAS 1. That's the problem. That's the problem. IAS 1 shows the presentation of a P&L and a presentation of a balance sheet and a presentation of statements of changes in owner's equity. But people jump it all the time. And it is IAS 1 we use to do ratios. If you watch my ratio video on YouTube, I've explained it. Yes, I've really explained that. Go to YouTube, search Thomas Ansah, type evaluation of financial statement. You see, it's there. Let me even show you. Those of you probably you've joined anew. When you go to YouTube, I'm learning. You see, I'm learning research. It's not easy. I'm doing a bibliometric analysis. I need some information. So it's not easy everywhere. Everybody is a student elsewhere. So if you come here, you type Thomas. Hey, what is this thing doing? So you type my name. You see, if I type Thomas, it will come. Now you go to, there are plenty of videos. This is corporate reporting and SBR. When you go there, find the evaluation of financial statement. You will see I've explained deeply using IAS 1. This is it. It should be part of the playlist, probably the last one also. This is it. I'm not even done. There is only part 1 there. I've explained it using IAS 1. How to do common size, how to do all those things. But you need to know your IAS 1. Guys, it's just open to IAS 1 and just have a look at it, how we do P&L. Okay, let's have a look at it. So you realize that over there, I take time to explain how the P&L should look like when you are doing console P&L, and how you must arrange the things. Okay, even how to write your answers. I've shared it there. So go there and have a look at it. It will help you. All these console that we are doing, they are all there. It will help you. So here we need to add the 1067, the administration, staff administration expense. This other expense is not we have only
say your voice.
Oh, only God can help me. Hello, is it okay?
Yes, please.
I said IAS 1 says there are only 3 types of expenses. We have operating expenses are 3. We have selling and distribution, administration, and research. That's all. That's all. All right. So, guys, that is it. So here they gave us some other expense. We don't know what goes into the other expense. So you to repeat it, other expense. The figures. Yes. So we have 17,500 plus 9,500 plus 6/12 of 4,000. What else hasn't come? Who remembers? There is something that has not come.
So is it the excess depreciation thing?
The excess depreciation thing. Exactly. Exactly. So you see, this excess depreciation that we were doing, we are not going to do. So the choice is yours. Since there is P&L, this one is consult P&L. We are not doing balance sheet. You can skip the transfer to OC. You can decide to skip it. The transfer to retained earnings, because it's the same thing. Then you can do your normal thing. You can do the split of deducting 1,001, and the remaining will go to your SPL. So the remaining will go to the SPL. Or you can also keep to the 1,003 going to your SPL. Effect the change in your other comprehensive income. So this other comprehensive income that is there, you will reduce it. You will reduce it. So that is that. All right. Because this other comprehensive income is coming because of valuation. Just to keep the thing short. And
the voice is gone low.
All right. So like I'm saying, you can offset this one with 1,000 because we are not doing P&L, the 1,001, and keep the balance. The balance is like how much? If you do without doing the transfer policy, you know, this is a professional exam. You can say that the examiner is unclear about the transfer and you assume that there is no transfer to retained earnings and go on with it. So that is professional exam.
So you get 2,400. Hey,
are you sure?
Sorry.
If you offset this one with 1,001, it should be 1,000 something.
2278. So it should be
78 minus 1,100.
1,178.
1,178. So that is the other one. All right. So 1,178. You can decide to add it here. 1,178. Or you can also decide to do the 1,003 and go and reduce your OCI by the balance, the 122. All right, it's the same thing. All right. So that is that. What are we left with? So after that, you get your operating profit. So nobody is punching the figures.
I'm doing it.
Okay. Please, others should also do so that we don't get mouse medicine, i.e. incredible. So let's add all investment income and finance costs. So share of profits.
Revenue is 2,550.
Revenue is
258,650.
258. I will need two answers. So 258.
Sir, I got 269,000. 269,000.
It's 269,000. Confirm.
In the math of 2 or 3, a matter is established.
269.
So go on. Share of associates.
191,500.
191,500. Gross.
77,500.
Hey,
Who said hey? Is everything okay?
Who said Pia?
If you've gotten any figure, you can please say it. Or it's okay.
What was the share of our associate profit?
So,
750. We can number these workings, all right, and add it to it. 750.
Please, if you've gotten any way, you can say it.
Then the profit from disposal.
Other income.
Other income,
1,833.
Yes, correct. Confirmed.
11,833.
yeah.
Profit from disposal. That one I
Admin
remember.
costs.
It was 11,000. I remember.
Admin costs.
Admin cost.
18,567.
18,567. This is a subtraction. Confirm.
Yes.
Sir, I got a different figure. Someone should confirm mine.
Hey, you had what?
16,788. Hey, Nedeni.
This is 2,500.
Sir, it's 16,785.
Hey, no, I can't accept yours. I can't accept it.
18,567.
Okay, that is correct.
18,567.
567.
18,567.
All right. Continue.
Other expense.
Other expense.
30,178.
Yes, confirmed.
What? 30?
178.
30,178.
3178. Okay. So the rest of the things left for us is finance cost and finance income. All right. So finance cost and finance income. So finance income first. Finance cost. All right. 3,000 plus 2,500 plus 6/12 of 4,000. Finance cost.
Sir,
Yes, please.
sir, please, where did you get the 1178 under the other expense?
This one.
Yes, please.
It is the PP.
Except the position. Yeah.
It's here. We said that you can decide to use the 1,003 and go and your this one by the OCI, or we just did. Of course, you are offsetting. Don't forget, this thing goes to OCI. It will go to OCI. So when it goes to OCI, this is going to offset it. So when you deduct, you get the 1,178.
Okay.
All right. So this one is 2,500 plus 1,005, then 6/12 of 2,000. This is a finance cost, so it should be in brackets. So I'm waiting for the figures. I think we are done.
So the operating profit is 40,588. Someone should confirm.
All right. Then When we finish, that is profit before tax. Then tax. 9,500 plus 4,500 plus 6/12 of 2,500. Tax is a subtraction. And profit after tax. Yes, I'm waiting.
Yeah, operating profit is confirmed.
Yeah, but I'm waiting for the other figures.
Finance income. 7.5.
Here.
7,000, yes.
500.
7,500.
Confirmed.
All right.
All right,
Cost.
confirm.
The auditors are making out. Thank you.
Five.
5,000. Finance cost.
So profit before tax, then tax. We have OCI. But we will share profit, we will share the OCI. So normally I prefer you.
Profit before tax. 54,838.
Confirm.
Confirm.
Income tax expense 15,250. Profit after tax 39,588.
Mary, your hand is up. Mary, your hand is up.
11,000. Yes, sir. Are we adding or deducting?
It was a profit you are adding.
I thought that one was for disposal with loss of control.
Yes. And it was a profit. We can't deduct the profit.
The fair value of it.
This is it.
Okay. Without the loss of interest is what? Okay. Thank you.
Apinga.
All right. Now, guys, this is where most of my students say they don't understand how you share the figure. This is how you share the figure. You first do the NCI first, but the NCI sharing is from your working stool, share of post-acquisition profit. And if there is NCI impairment shared, you also subtract. So that is all you do. Then the difference will be the owners to the parent. So this one that you already have your acquisition retained earnings. So like this one. And don't forget, this guy, the NCI is just a 6 months NCI. Don't forget that for this guy. So this one is a full one. So NCI is like for this PTS, it will be, what is the percentage of the NCI? for PTS?
50, so it will be 48.
No, that
40%.
thing was on the last day. It wasn't.
Oh, okay.
before.
So
Yes.
60%.
That
So
when you
40%.
dispose on the last day, it is irrelevant to your analysis.
40%.
So it's
Yeah.
still 40%.
Yes.
Mhm.
So 40% of 11,000. Then this one is 6/12 of 7,500. And what was the NCI then for the 6 months?
No, it was 40% for the 6 months.
Okay, so 40%. That's all. If there is any impairment in any of their goodwills to be shared among them, then you deduct. So you remember they told you that the impairment has already been done with the reversals. So this figure already has the impairment covered. And we have gone back to do the reversal. So the impairment has already been taken care of. Now, the NCI share of impairment, if any, so somebody asked since the fair value method is used, the goodwill must be shared among them. So the NCI portion of the impairment must be deducted from the NCI share of the profit. The only difference is that in this one, it looks as if the person told us that it has been captured inside. Other than that, where was it? Did it say something like that? All right, it says that, yes, there was no impairment because by the time the year ended, the impairment was reversed. Do you remember? And we have also gone back to do all the reversals needed. We have added back. Impairment had reversed. And 1 million above. The upward change has already been included in the draft. So everything had already been included before. And we also did all those changes in them. Other than that, you should subtract the impairment loss after you have gotten the 40% of the 11. Just as you do in your impairment workings 4, you will take share of you will take NCI share of post acquisition, NCI share of goodwill. Those are the only two things that comes here in consult P&L. All right. So take note of that. So do that. Then the balance will be for this guy. Then the OCI too, you do the same thing. You know the OCI, there is 5,000 there, but you need to minus the 1,011, the one that you offset with the what do you call it? The loss, the excess depreciation, or the revaluation loss that happened. The one that will stay in the OCI, you need to do that. And I think that we did something that also concerned OCI. I don't know if you guys remember. We did something that concerned the OCI. I've forgotten it, but we did something.
The IFRS 2.
The IFRS 2. No, the IFRS.
No, not that. So it was a revaluation thing, but because there was loss and then lesser depreciation, we did that transfer thing.
Yeah. I remember we did something.
Oh,
But
go to the workings. Go to the workings and let's see.
Yes, it was goodwill.
That okay.
Or was it goodwill? I think we've done the goodwill too. We've reversed the goodwill.
Only the certification to look at OCI.
So go to the workings and let's see.
This one, we've done it. We've taken the 1,001. I remember we did some, was it? Or we've captured everything. I think we've captured everything. Yeah. There was there was some information be 4.745 information. There is the move. What was it? Where is the
I said,
this one?
is it the said to be the note II?
Note II.
Oh,
Yeah, this is it. This is it. It said that the carrying amount bank account for investment in subsidiaries. They put gains in OCE. IFRS 9 instrument has been released to show gains and losses in other comprehensive income. Carrying amount of PTS is was this as at this. So the IFRS 9 instrument, this one, fair value, they did this one between 4.45 and 4.7 has been carried into, the investment. This is it, 45 million. As at 2017, this is the value. As at 2018, this is the value. I hope you remember those things we do in IFRS 9. That if you have fair value and the fair value change, fair value change.
go to PNL.
It's actually supposed to go to PNL. But these people said they carry them in the OCI. So it means that we should take it out.
Yeah, this is why we're even saying that. You see, they said they account for the investment in subsidiary using way, but you said it is wrong because investment in subsidiary should be accounted using IFRS 3. That is acquisition account.
Yes, and they have done this thing, putting the figure in the OCI. So we have to take away that one too from the OCI because they are supposed to rather use acquisition account. So that is another thing you must learn too. All right, I mentioned it, but I didn't write it. And it nearly cost us. So that 2005, the difference between these two things must go. That is 2.5. So I think we are done now. What is the figure? Please, you will share it too. The same way you share, you will share this one too.
So you get 1.4.
Which one?
This OCI. One.
But this is your figure. So you can decide to do it this way. You can decide to finish the total, then you share it among them. So I can decide to carry the whole of this thing here. So carry it down here.
That one is 5,900.
The NCI is 5,900.
Yes.
Yes, sir.
All right, so let's carry these ones here. We are done. So and put these ones up. You said this is 4,100. What is the total?
So it's 1,400.
Yeah. So what is the total?
You get 4988.
49.80.
49.88. So if you take the 5,900 from it, what will be the value to the CI, owners of the CI?
33688.
33688.
88.
All right. So that is it. So, ladies and gentlemen, this is it. A question that handles all the forms of disposal that you might get. This one, after he disposed, he kept an associate income. The next time probably you go to your exam, you find out after he disposed, he kept an investment interest. Then that is that. I think you have to, the investment interest, it depends on the type of IFRS 9. Is it fair value through P&L or fair value through OCI? Whichever the one they will say, then you utilize that. Yes, Andy Rich, your hand is up.
Said the OCI, instead of adding it to the profit, can you decide to do that one also attributable to? Then you give
you can do it separately.
Okay.
You can do it separately. But that one, you could see clearly that it's just for the parents. All right. Any question? We are done. What did you learn in P&L? Yes.
Sir. Sir.
I'm listening.
The owner's share, I think the figure is wrong.
It's wrong.
They've given us mouse medicine.
Yes.
35,083.
So if you take 5,900 from this 40.
Yes, you get 35,083.
35,083.
Yes.
Who gave us the mouse medicine?
Sir, the profit after tax is it 80? It is 83. Anna.
Oh no. Depending on how you want to approach it. You see, you know what? Let's share the profit, then also share the OCI. If you like, let's do it like that. Probably
no, sir, the problem is not here. Yeah, the problem is the 39.5, the profit after tax.
It's wrong. I saying the figure is wrong.
Okay, I had 583, but I think yes, it's wrong. It should be 583. The tax is 15.
How can it be 583 when here is 8?
It's 39,588.
And that is what is there.
Everything is correct.
So the only thing is the owners, the attributable, the owner, then no. That of the parents,
Should be 35,088.
Yes.
Oh, okay. So I think the person who did this is probably saying that you have shared the profit, so we should share the other side. So it means that you can share this one only, then you will share again. So this one is probably like this. I think that is what happened. So this one should give you this 39,588 shared. Then you do for like the way Rich you asked. So owners of parents again. Then the NCI again. The NCI is 5,900. Then what you get, you said is 35 what?
088.
088. Then here two balances like 40,988. So you have shared the P&L and you have shared including the OCI too. So that is that. All right. So that the balancing is this versus and this versus this. That's all. Okay. Anyway, Class, what have you learned from console P&L? Is there something that you didn't really pay attention to in your previous classes or previous?
Please, we can't hear you.
I said, what lesson have you learned from this? What lesson?
Say still we can't hear.
Wow. Hello.
It's okay now.
What lesson have you learned so far with this?
So what's I to call?
I'm going to write it on the screen.
Hmm? No, I didn't solve it.
Yeah. What lesson did you learn from this question?
We have learned a lot.
Yeah, I just want you to name one.
I think it's an examinable question.
Especially the disposal.
It's loaded with so many standards.
And so it means you need to learn your standards. I believe that this time round they would drop the IFRS to us, not as a major. Okay, so somebody said how to treat disposal without losing control. Okay, and how to do disposal when control is lost. All right. So at least the disposal, in SCCA, disposal is a level 2 thing. It's in FR. And I wish ICA would have adapted it. But unfortunately, ICA don't. And so it makes the whole thing look like, some way. Okay. But for you, you have to know it. So ladies and gentlemen, this is the second